Hello, my name is Jacob Watkins, and today I'm going to be talking to you about if crypto is a good investment. First off, we need to talk about what are the goals of investment. To be able to judge if crypto is a good investment, we need to know what a good investment is. There are two criteria that we look at when choosing good investments, and that is growth and stability. This is obviously oversimplified. There are many, many factors that go into this. These are two major ones that we look at. Growth being obviously we want that asset to grow over time so that our wealth builds and builds and builds on itself. And second is stability. We don't want to have our net worth being just fluctuating up and down over time. Even if that growth is net positive over time, it causes a lot of stress. And if you need to sell out at a certain time, you might not have the assets to sell because they're devalued all the time. There are, in general, two types of investment assets, but I'm going to lump in a third one for the purposes of this presentation. And those are stocks, bonds, and currency. Stocks is a type of ownership. So when you buy a stock, you are essentially buying a part of a company. So that works with Apple, that works with any of these giant companies you know of. You go and you can pay cash for an ownership stake in a company. Bonds are debts. What I mean by that is when you go get a mortgage, you are essentially creating a bond. It's not 100% true, but essentially. So the bank gives you money, and in return, they get interest. That interest, essentially, at the end of that term, means they generate positive growth. So, on a $1,000 loan for a year at 7% interest rate, they would receive $1,070 back. So that grows over a set period of time. And cash isn't normally considered an investment asset, but in this case, I'll say it can be. And the reason I say that is because you can't exchange one type of currency for different currencies, and those price to each other, like the exchange rate does vary, and so there is a market. Okay. In investing, there are also two types of risk. The first one is market risk. This is essentially what I was talking about earlier, in which you have an asset, and since that price fluctuates over time, if you need to sell something, but it's at a low, you don't want to necessarily sell it right then. That's market risk. It's the fluctuations in the short term of an investment asset. And the second is inflation risk. Inflation, it's a term that everyone throws around, but what inflation is the steady increase of prices that devalue a currency. So, as an example, let's say milk last year cost $1. And this year, it costs $1.03. That means inflation over the last year was 3%. Those are the two types of risk, market and inflation. Each type of investment asset interacts with risk, the two types of risk differently. Since stocks, in general, stocks have a higher rate of return. This is because one good way of looking at it is companies sell bonds or offer bonds so they can get capital. So basically they go into debt so that they can basically increase the value of their company. So if they didn't receive a bigger increase to their stocks than the loss they're making from the bonds, then they wouldn't do it. So in general, by the very nature of how it works, stocks have to outperform bonds. So what that means for stocks is that it has market risk because the stocks change value so often that you can't always know when's a good time to sell. That means they inherently have market risk. Bonds don't have market risk, and this is because when the price of a bond can change, but that's generally in proportion to the change in interest rates. So when interest rates go up, bond price go down, and vice versa. And so net, the bond will stay the same value even if the price changes. That means there isn't any market risk. And again, these are oversimplified. There is some nuance to this that I'm not going over. But in general, bonds don't have market risk because the interest rate changes the price of the bonds. However, what it does have is inflation risk. Bonds, since when a bond is created, there's essentially an already set payout at the end of that term of the bond. So like I said in the earlier example, that $1,000 loan that you got, you'd have to pay back $1,070 at a 7% interest rate, which is high for a bond. But what that means is if inflation goes up by, say you expected a 3% inflation rate during the term of this bond, but it suddenly was a 5% inflation rate, that means that the bond itself devalued itself by 2%. Meaning that bonds, since they have in general lower rate of return, are more affected by inflation risk than stocks are. Stocks are not generally affected by inflation risk because companies can raise their prices, and so the value of the stock goes up along with inflation over a long period of time. Currency, as let's call it the third asset group, can have market risk, but let's ignore that for this presentation, but does have inflation risk. Since it's just sitting there, inflation every year eats out of the value of it. So now that we know what the three investment assets are and their risks, let me go over currency more. Currency has three goals. It holds its value, it's a medium exchange, and a unit of account. Those are very fancy words for saying it doesn't really change its value that much. So like 3% is a reasonable inflation rate. It's actually a little high, but it's not like constantly going up and down. It just kind of, especially in the short term, holds its value. Medium exchange is that you can go essentially anywhere you would need to and exchange it for goods or services. And unit of account meaning that it comes in discrete units that can be differentiated from other discrete units, meaning it's not like a lump of gold that can be somewhat dissimilar, or it can be somewhat similar but not exactly the same as another lump of gold, meaning that those technically aren't worth the same, but it's hard to say which one is worth more and by how much. They're comparable and discrete from each other. So $1 is the same as another dollar, $2 is more than $1, that's always known. So what is cryptocurrency? It's a little bit, not a little bit, it's a lot in the name. The goal of cryptocurrency is generally to be a currency. The other goals of it is to be decentralized, meaning that it's not controlled by a central government or, some company. And it's also a peer-to-peer currency, meaning that I can exchange it directly with someone else instead of having to go through a bank or a government. So let's go through the checklist and let's talk about cryptocurrency for a second. Crypto, in general, is known for being very volatile. It goes up and down, and doesn't necessarily, as we've seen actually in the last year where it dropped about 30%, doesn't necessarily sustain constant growth. And it especially doesn't contain stability. A good currency, however, holds its value, which cryptocurrency also doesn't do, is not generally accepted. You can't go to most stores and exchange Bitcoin for, eggs. And one thing actually crypto does have going for it, that there's a set amount of crypto out there, meaning that they can't add more and can't take away more. So it actually does fulfill this one of being a monetary unit. However, that monetary unit thing is actually what crypto does actually have going for it. Because it's discrete and you can't add more or take away crypto in general, it's actually a big proponent for it. And since it's decentralized, you can't have regulation or monetary policy affect the price. And peer-to-peer is nice because you don't have to have fees from bank to bank. The conclusion is that since it follows none of the rules, it checks none of the boxes for being a good investment, and it also currently doesn't meet any of the checklists for being a good currency, I would never currently recommend investing in crypto. Crypto could, over the next decade or so, become stable and meet the checklist for a currency, but as it is now, I would not recommend investing in it.